All right, vertical stream is live. Funny story, TikTok banned us for no reason on the last FOMC, and we're still banned. So, joke's on you, TikTok. You're about to be banned, son. Get flexed on. Get the flex. All right, chats are pulled up. We're fully operational here. Let me see who's here today. What's up, Birdman? Jason? You're long on Gina? Oh, yeah, baby. B-Man, it's an election year. What do I think Biden will make Powell do? I actually have my qualms or whatever with Chair Powell, but one thing he does seem to do more successfully than any U.S. politician is remain bipartisan or non-partisan. I don't know. He seems to be pretty insulated. Professor Beans here, pretty insulated to the politics. So who knows, man. If we look at election years, we typically expect nothing bad to happen until the election is over. I think that makes sense that people use all the power that they have to prevent anything bad before election, right? That goes both ways. We got just under 2 minutes. What's up, Jason Cooper? Sun's out, guns out. I've been getting some sun. I've been touching some grass. Hopefully you guys have too, while the markets have been less spicy than usual. What's up, Smokesar? Go get that money. Nazreddin Kirkoof. What's up, man? Long time no see. I'm always here live. We're live here 3 days a week or more, publishing content every single day. Make sure you guys are subscribed. You have the notifications enabled. You don't want to miss our streams. You also can jump into the Discord. Highly recommend that. You can claim your free VIP access to our trading rooms there by signing up with any of the partners in the video description below. Can't beat that deal. Shout out to our sponsors, LuxAlgo. Use my link. You can get a free month risk-free trial. Do it. Just do it. Just do it. Even if you don't like it or don't buy it at the end, just give it a shot, see what they have to offer. They have so many tools, it's worth it. As well as our new sponsor, metasignals.io. Speaking of that, actually not speaking of that, because the interest rate decision is about to come in and it's about to be boring. I mean, it's about to be the most exciting interest rate decision in the entire universe. I'm going to pull up CryptoCraft here. Nice little site. It's got some, typically keeps us in the know pretty quickly. 1 second pending. Let's see how long it takes them. Pending. No change. No change. I beat you all to it. Ha ha! Ha ha, suckers! Does anyone have any contradictory stuff my side said something else, blah blah blah? What's up, Deep Forest? I see you, bro. 𝐂𝐴𝐺 over on Facebook shared the stream. You a G, can. Keep those subscribes coming. Keep the likes coming. We got 30 minutes until Chair Powell speaks live. So we're going to do a little TA. We're going to answer some questions. We're going to field you. What are you feeling? How you doing? How have you been? What's up, Adam G? Omar, Sharknado, Paris, Verma. You're building a crypto asset management company. Any advice from my side? That sounds like a very difficult feat, my brother. It'll be really good in bull runs. You'll be a genius. And then when the market turns, yeah, people are going to be mad at you. That's my advice. Be ready for that. What's up, B4 Crypto? Best place to be, that's right. The home of the FOMC. Rates unchanged. Thank you, Scorch. What's up, Christoph? Come join the Otter Gang. How do I become... Can I become an otter? I would like that. They seem to live great lives. Have I been shorting now? Honestly, if you guys have been tuned in over the last 3 weeks, and I would not blame you if you haven't, pretty much through all of this price action, I've been saying, guys, I don't like these trends. This is not the trends I like to trade. I don't like sideways markets. I like trending markets, and I pretty much just pulled my trades. Admittedly, I did get stopped out of some amount of longs at some point along this run, but in general, I have been keeping no leverage on the table open. My G long from 16.5K got for some reason, I don't even really understand why, but it got closed at 67,000 maybe a month ago. Something to do with funding. I had it open all the way since the start of 2023, so it was about time. Definitely netted some sweet profits on it, but I'm not trading. I'm waiting to see this resolve. And at this point, if we want to be very basic 101 chart with it, we technically did see our range resolve, didn't we? Not a great sign. We broke down 60K. We've fallen farther. At this point, we may be looking for the trend to have a longer retracement or down, whatever you want to call it. More downside, more red. That probably, though, won't look like this for anyone freaking out today. Unlikely. It's not a very common crypto pattern, except for rug pulls. If you're buying soul meme coins, maybe. But on Bitcoin, not really what we expect. I would probably be looking for something like this. Now, I'm not going to make any calls until Chairman Powell speaks today. I think quantitative tightening coming to an end could be enough of a catalyst for not just Bitcoin, but for all markets to see some considerable bounces. But here's what we might look for. We did break our low. We have a Fibonacci retracement. We broke the low, so where do we look? We look to our 1618 in our 2 measured move, right down here. So 55.2, 52.8. After that, or maybe even possibly before, likely going to see that 60K number close or tested again. So anyone freaking out about this drop, you may be rewarded if you have a little bit of patience. I think the bearish move here, or for the bears, is not to enter a market short in this moment. Though do whatever you want. I don't care. It's your money. But to wait and see that price move back up to that 60 zone after we find some kind of local bottom or some kind of signal of a local bottom. That would be my play. I may, in fact, take that trade. I don't like shorting the corn, but trade's a trade, right? We'll see how this plays out. Interest rate decision is in. Let's update on our charts here really quick. Looks like the dollar eating it off of that no interest rate decision, which is wild considering 99.5% of people thought this would happen. It is weird to get such a reaction. The dollar has dropped actually pretty considerably for 5 minutes, almost 0.2%. Gold enjoying the weakness on the dollar here, wicking low on the interest rate decision, now rallying again. Let's actually look at the hour. Ooh, coming back up to 23.11. Reminder, gold's still at like an all-time high. It has honestly done kind of as Bitcoin has done. Let's see. Hitting its high up here mid-April. I guess that's a little later, but still. Hitting its high mid-April, lower high. This is actually really similar looking even to Bitcoin. You have this rising wedge breakdown. You hit a low, dead cat or whatever, really weak bounce that brings you to the next level lower, another leg down. So weirdly pretty similar to the corn there. I actually didn't expect that. But gold seeing a little love. Wait. Yeah, gold. Thought I had stocks up for a sec. Whoa, Nelly. Stocks actually faring a little better, hitting a low, definitely a lower low there, but now potentially on the second consecutive lower high after higher high. That's good stuff. That's very good stuff. Oh, man. I think this is going to be spicy. I think it's going to be real spicy. Gold. I'm going to get rid of gold on the... Oh, no. I'll leave gold. I'll get rid of stocks for a sec, but I'll hit alerts on them. I just feel like 4 charts is too cramped. Everything's too small. Okay, let's go to the 3. Bitcoin liking that weakness on the dollar. Really hasn't gone anywhere yet, though. I want to see a lot more of a bounce before I get too excited about it. Here's our typical volatility, though. Let's see. Clearly a rally from interest rate decision into Powell speaks live. Clearly with that green candle, likely to see a reversal on this if we're just following the basic FOMC trading plan. Whatever direction it moves after the interest rate, we typically see it reverse on Powell speaking and then kind of return to where it was, basically like a heartbeat on the chart. And this is why it's so dangerous or so risky right now to trade, is that pattern tends to stop out both longs and shorts. So even if you magically picked the right direction of the market, you might end up getting liquidated. Just be careful, guys. And if you are going to trade, you might as well sign up with the partners in the video description below. Get your VIP access in our Discord. But please don't. Just be safe today. Capital protection today, man. I'm liking this. I'm liking the vibe. Weak dollar, thank you. Gold, a little bit of strength, but meh. There we go. Get them set up right. Get rid of this. Boom. Done. All right, boys. So what should we do? What should we do? We got like 20 minutes. What do you guys think we should do in this time? Let's make the most of it. What's up, Satoshi Nakamoto? He said, hit that like button, please, on a $2 super chat. Appreciate you, my friend. Great advice from Satoshi Nakamoto, the creator of Bitcoin, joining us live for the FOMC. What's up, Naz Redine? Quick question in all caps. Why NASDAQ and S&P have 5 candles? Because they're like the same thing. There's the US index. In my experience, they have always trended really, really similar. Lots of correlation. What's up, Ole? Let me see. Who did I miss? 2147B is here. Great name. 26-Day Enterprises, Ace of Hearts, Acid Monkey, AJ Kadam, Alchemist, Alexandra G. How you doing, darling? Andoni, Odyssey 1. How you doing, man? It's been a bit. You weren't around. You haven't been in the Discord. We miss you. What's up, B-Man, Brendan, Christoph, Coca-Cola, Crypto Beehive, BG. What's up, man? Crypto Esquire, Sharknado, Dave Digital, David Williams, Ernest of Gaia, Get Wrecked, Grim, Inik Jatiwa, Jack and a Crack, Japernicus, Josh Day, Jorn Besser. What's up, Kai? Kai's joining us. We got some hotties in the house. What's up, Crunk C? Lying in my pocket. Loading name. Mary Beth, Matthew Smeed, Matthew Morissette. Maybe Abandoned, Mohammed, Mr. Poppy, Neil Snurb, Next Car Auto, Nahung, Ninja Glock, Operum, Panda Poet, Pennyways, Raja Bell, Rivs, Sausterus, Scorch, Senor Scoops, I'm almost done, Siberence, Smatoshi Smakamoto, Sibby, Toby 86, Softshell, Steven, Taylor Tales, TD Pickle, Tillin, Tor Crash, Vanessa's here, Vicious Teletubby, Vishhearts, Wick, Willie, Zanzan, and Monkey. What up? What's up, Michael Morris? How you doing, man? I see you over there. No Eggs, Vigilante Experience, bringing us the best in the Bitcoin luxury watches. Got it right here. Had to take it off. Got to adjust the band. What are we looking at? I'm refreshing the chat. No change is good, right? It's honestly what the markets expected, and I think we can say pretty confidently that whenever markets expect things and it happens, that's good. Really, the only thing that's like bearish for markets is when things are unexpected. So had we gotten an interest rate cut, that could have been bad. Or even an increase could have been bad just because it wasn't expected. Markets crave not consistency, predictability. That's it. Did you get your Coin Vigilante watch? I did. It's very hard to see. It's very hard to see here on stream, but yes, it's beautiful. We ripping. Oh, we'll be ripping after. Isn't our peak bull run supposed to be the very end of 2025? I mean, supposed to be. What do we mean by that? But that is what people say. I'd agree. I mean, look at it this way. People are looking at 2019 a lot now. They're saying, oh, well, they're thinking it earlier, but now they're saying, oh yeah, mid bull run kind of rally that gets sold. Were we in a bull run back here in 2019 when we rallied from 3,100 to 13,800, something like that? Was that a bull run? Was it not a bull run because then we went down again? There's some kind of truth or reality to both answers, right? We could say this is a bull run or it was part of it because we never went lower. So that was like the first step, right? So people are saying, oh, 2025. And then they're saying, okay, 2019 is what we're seeing now. So what might that entail? Like question mark downside. Something tells me we're not going to be moving back to our range lows. That was a kind of once in a lifetime pandemic issue, but some kind of retracement. And what if we saw the exact same price action, right? Sideways at this high and then a slow bleed over time. We bottom out somewhere and then we move back up. We've already hit an all-time high. So we are in a bull run, or we were in a bull run at worst, unarguably. You can't have all-time highs and not be in a bull run, but we could still have considerable downside. I don't know if I'm sold on that yet. I was expecting that. I was expecting like a 2019 repeat at the start of 2023. We didn't get it. Is it possible we have it now? Absolutely. Nobody knows. People are going to be yelling down, up, left, right, and in the end, the ones that end up being right will say how they knew it and how everyone else is stupid. In reality, they just had an opinion and turned out to be right. No one knows the future of markets. Bitcoin isn't supposed to do anything. Price-wise, isn't supposed to. It's supposed to go up over time, fight inflation, whatever. But that's it. It can do anything. The amount of fear, and actually more bullishly to me, the amount of influencers that I've seen turn bearish, just honestly over the last week or 2 weeks on this little low, that makes me bullish. Only a few months ago, I was complaining about how there's a lot of like bullish influencers. It's weird to me because we were streaming live back in 2020 and 2019 back here. And if you were on this channel, I know some of you guys were, we were the only bulls. That's it. People thought we were nuts. Like literally people thought we were insane. That's very different than what we saw over the last year and a half. So maybe we're getting a little expectation sentiment adjustment here. The more people get bearish, the more bullish I'm going to feel. And reminder, guys, I'm always bullish. I'm a perma bull. I have waited for Bitcoin to go up for years and years and years and years, and it always has over time eventually. See, I told you. I knew it. Capo was right. This is like double take stupidity. We got some viewers. Make sure you guys are smashing the likes and subscribes. Chirp out now less than 15 minutes away. 2:30. We got like 15 minutes to fill. I should have done more homework. If you didn't catch the intro, I did have some good points, some good alpha drop. I did threw them in. It was probably only like 5 minutes, but worthy of going back and listening to again, or listening to it for the first time. I guess I'll recap because a lot of new people have joined really quick. Markets are and did expect zero interest rate change. That's what we got, but that's not the exciting part today. The big curveball that we could see, that could be that bullish catalyst, is an impact to the quantitative tightening or quantitative easing cycle, process. Basically, the Fed looking, and they stated this in the last month's notes, I believe, that they're looking to drop their, freaking bugs. Bugs love these lights, man. They come out of the woodwork. Looking to drop their quantitative tightening from 60 billion a month down to 30 billion a month. And effectively what that does is inject liquidity into the market. It like essentially creates money. When they quantitative tighten, they're reducing the supply of money in circulation. And when they stop that or ease, whatever, you're increasing the supply. And that tends to have a bullish effect on risk assets. Not just crypto, stocks, whatever, bonds. Should be a big day for bonds. That was one of the quotes. In fact, there we go. I found something to look at. I'm going to pull up the little bond chart. Mostly because I haven't looked at them in a while. What's up, Andoni? Like the stream. Yes, do it. Like the stream. You must. There we go. Huh. How long ago did that happen? Either way. US 2-year. Sitting at 5%. No big change today. Thought this had more charts. Nope. We are not quite above the 5.259, aka the federal funds rate at the moment. We're not quite above there on the 2-year yield. We're at 5%, and you can see the little line up there says interest rates coming if you break above 5.25. Not quite there yet. Not quite there yet. Probably not going to get there till the end of the year. That lines up. That sings. Let me pull up the 10-year quick. Get rid of that awful white background, man. US 10. Oh, man. Not going to lie. I still don't know what this is. You go to the US bonds, like 10-year, and it's like 95 minutes. They've tapered one. I don't know. I don't really understand that, actually. I understand going up and down. But it's like it's given us GPS coordinates or something. 95'01'0. I should have just Googled that before. There we are. 10-year rates not moving either. Interesting. I guess we're going to have to wait. These may see big moves once we actually hear them talk. I think we can even infer that if they don't talk about quantitative tightening or easing, that we may get a reaction from the market anyway because people are expecting them to. That may be a shakeup. That'd probably be a bearish outcome. Nice little reversal. Not a lot going on. What was I going to do? I know what I can update you on quick. Burn 5 minutes, maybe. Oh, you get out of here, you freaking bug. Our TRX for Meta Signals. We put this up on Monday. We just took one of Meta signals, put it up on the chart. They're our new sponsor. Position has not been stopped yet, though. TP1 has not been hit. I just wanted to update you guys out of like clarity. This is just an interesting experiment. They're new. I want to give you guys real examples. You can see them live, what's going on. We are pretty close to the TP1. I think that's going to hit. A lot of you thought it would get stopped. TRX, though, man. Do you guys know that TRX Tron has like 50% of the USDT that anyone uses is on Tron? Not even chillin' Tron. Just, you wouldn't think that based on how much people talk about it or even invest in it. I don't know anybody who's like, I'm buying Tron right now. Except maybe if they're trying to send USDT, that's about it. All right, 10 minutes, let's go. I trust you, Johnny Cage. Thank you, man. AJ coming in with unchanged, indeed. But that's not what we're looking at today. That's not the spice. Henry O'Manley trades currencies and destroys nations. You can get on that guy's bad side. When Powell print again? God, I wish. Benjamin Cohen predicted this dump last month. Good for him. Benjamin Cohen's a great dude. I don't like his stance on FOMCs. He's very anti-FOMC being hype. Oh, shoot, I missed you. Steve. They've tapered quantitative tightening, Tom. Yes, that's what we're listening for. That's what we're watching for today. I'm going to put my headphones on because I'm going to need audio. There we go. Just 10 minutes. Ben's anti-everything. Yeah. You know what, though? Being a skeptic is almost part of crypto. So you can't really fault him. Ooh, it's May. I forgot. Chairman Powell. That's right, Alex. It is May, so we have more free memberships to give out. Headphones making weird noise. More free memberships. So you should make sure you've opted into membership gift receiving because I'm going to be gifting these out probably before Chairman Powell even speaks. YouTube says that they give them to those who engage with the live stream. So make sure you've subscribed, liked, opted in, vote in the poll, put a message in the live chat, just get the engagement. And in fact, can we do like 30 seconds of spam? Do you guys just want to spam it out? Is the sub counter stuck? It probably is. Oh, yep. I had it minimized. I guess that goofs it up. Here we go. 107,202. Let us be engaged. Let us engage together. Let me join you guys. Spam. Spam. There it is. Spamage. Can you get one, Ghost Watch? They're random. You literally cannot choose someone to give a membership to, which doesn't make sense to me. I wish you could. There we go. Powell is a headache. Yeah, he is. Spam it up. Mike Bennett, I'm so tired of crypto influencers showing their clips. I told you so. Isn't it funny how the people who say I told you so, like, apparently I've told you so in every direction, every time it's moved. Doesn't even make sense. It's like they're in a long and it goes down. They're like, I told you so. You're like, I guess you did. I don't know. Beware of people who say I told you so. There's too much ego there for him. All right. You like the number 36? Well, I like you, friend. Put some chirp pals. There we go. Good spams. Oh, such good spams. Let me gift out 5. I'm gifting out 5. Drop them. Dropping them in the chat. Any chance Powell says 3 rate cuts this year, Chester? 0% chance in my mind. I think 0% chance. We were looking for 5. Then we're looking for 3. Now we're looking for 1. Let's be real. We probably aren't getting any this year. If we do, like I've been saying for a few months now, following the FOMCs, it'll be like in Q4. It'll be like November, December, if even then it happens, right? All right, I gifted away 5. Congrats to the winners. I don't know if it's going to tell me who they are, but it's kind of a D sometimes. Changed, unchanged. Indeed. But we have much spicier stuff coming up, guys. If you think it's unchanged and you're just going to close the stream, no. First of all, leave the stream open. Even if you have to go, you can just mute a tab. But no, there is much more important stuff today. Much more important stuff than interest rate, because we knew the decision. Probability markets, 99.5% chance of no interest rate change. That's what we got. Not a mix-up of any degree. Not a mix-up. But the tapering. This is going to be the new narrative, the tapering. We were all hyped for like cuts or like raises of interest rates. Nah, new meta, tapering meta. We're all about the tapering. Inject that liquidity back in the market, make everything pump. That's what we're looking for today. Any talk of quantitative tightening or easing, gonna be on our radar. That's what we're looking for today. That's the big talk. Everything else is gonna be the classic. Nothing burger, data, maybe there's protesters, maybe, I don't know, Chairman Powell says a bad word. Gina will ask some really great questions. God, she's so smart and beautiful. But quantitative tightening and easing, that is the name of the game. Today is the biggest FOMC ever. Until next month. Then it will be even bigger than this one. What's up, Roshan? I see subscribing. Ali Alejandro, Ricky Saha, Isaiah, By the Dip, good name, By the Dip. Riley Charpentier, Jay Nayak, Jimmy Lee, Seamus, my Amish brethren, Sab55, Sunchips. I didn't catch that super chat. I guess this thing did, though. Thoughts on dominance. I do have a lot of thoughts on dominance. We only have 5 minutes. I was just talking about this earlier with Poppy, Crypto Poppy, our greatest Crown Analysis author, who writes our market updates every week, about dominance this morning over Discord. And I actually had something interesting that I'm not sure I've heard anyone talk about, not even Benjamin Cohen, not even the Bitcoin dominance master, Mr. Cohen. Humor me really quick. I'm going to do this very, very quickly, and it's not going to be in depth. So here is what we expect in a bear market. Dominance to rise. Overall market goes down, people risk off, gains go away, they retreat to Bitcoin as a safety asset, or maybe they exit the market. That makes sense. Dominance go up, market bearish. Dominance go down, market bullish. Risk appetite increases. People start chasing bigger and bigger and bigger gains. So at the start of a bull run, or into a bull run, we would expect dominance to drop. I haven't heard anyone talk about this, and it's so obvious. It's weird no one's talking about it. Let me know. If Cohen's on this, I will correct myself quickly. But I have not heard a single soul talk about this. Since the start of 2023, January, dominance has only trended up. It's only hit higher highs. It's only really hit higher lows, very clearly uptrending. This is, as I just said, what we would expect in a bear market. Yet Bitcoin went from 16,000 to a new all-time high. What? This has just been silently happening in the background. We've been following dominance, but I just didn't put this together. Dominance is diverging from what we've seen in the past. Now, we don't have a big sample size. We really only have 2 cycles to look at. The 2017 cycle, the most exaggerated and the best one. As soon as the market kicked off, dominance dropped. Dominance ended at a new all-time low. It was like a capitulation of dominance before we entered the bear market. And then we can actually go back a little bit further, but the same thing happened. Dominance dropped into a bull market. What in the heck is going on with dominance? I don't think dominance is done, but what is happening? I don't have an answer. It's just an interesting observation. It's not behaving like it has. And we could say now, well, maybe the bull market's over and we're going to go down. Yeah, I'm not going to argue with you on that. But this happened. It trended up to a new all-time high. That's not what we really have seen. What does it mean? I don't know. I do not know, my friend. Sunchips, I wish I could get into it deeper, but we only have a minute. 1 minute, 60 seconds. Guys, go grab your brews, roll them up if you got them. Chairman Powell is going to be speaking in like 60 seconds at this point. If you could, make sure you've hit that like button and you've subscribed. Let me shout you out. I won't be talking as much once Chairman Powell gets on here. I'll be joining you in the chat and occasionally commenting. But make sure you've hyped it up, share out the stream, jump in our Discord, discord.gg/TomCrown. Keep up with the fam. We are live here all the time, putting out content daily. June 1st, by the way. June 1st is our channel's birthday. We'll be 5 years full-time streaming on YouTube. Let's go. Couldn't have done it without all of you. Couldn't have done without every single one of you. Benjamin Cohen has distinguished between QE bull markets and QT bull markets. Well, I like the QT bull markets because they're adorable. Ooh, gold's kicking off. Gold's kicking off. Ooh. Didn't move much. QE is dominance down. QT is dominance up. Interesting. I mean, Cohen is a really smart guy. I respect him. Even though he's a little too bearish for my tastes. Benjamin Cohen. No. But he's very smart, great analyst. I respect him. Kind of interesting to draw that, and I get maybe why you would do that. Oh man, with the sample size so small. Seems kind of odd. I don't know. Not odd, but just doesn't seem like what I would do. Gold, apparently the big winner of this no interest rate decision. Gold now up over 0.5% in 30 minutes. The dollar finally showing some weakness here, breaking down. And Bitcoin locally hitting higher highs and higher lows. We're on the 1 minute. But likely going to see that mix up once Chairman Powell opens his mouth. That's just the way these go, baby. All right, we've got gold, Bitcoin, and the dollar. Do you want me to pull stocks up? Should we really have 4? Somebody always wants stocks to be up. Or indices. It's valid. I'd like to, but there's just no good way to put them on my chart. That's why I don't do it. 30. Wait, what? Let me refresh. Chairman Powell. Fashionably late as always. Audio check. Sounds loud. Rustling of Chairman Powell. Ooh, you don't even see this. Dope.
Good afternoon.
Coming up.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal.
No way.
Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month.
That's lower. That's lower than 30.
Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities.
Let's go.
With principal payments
Bullish.
on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Gina, first. Bullish. Let's go.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also we look at surveys of workers and, surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers?
No,
and you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that the data will have to answer.
So
The
as a
data.
follow-up, if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for
Expectations are not anchored?
or anchored?
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
I don't want to get into complicated hypotheticals, but I would say that, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina.
We want yes. Let's go. Everybody shut up.
Thanks for taking our questions, Chair Powell. I wonder, obviously Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. Our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too.
Bullish. Gina, yes.
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
She's such a cutie.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So on,
Let's go.
Let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%, and another path could be, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
Yeah, the data.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Did Chair Powell just save us? Did that really happen? Did we just get saved by a Powell?
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent
Drink.
has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained, tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably that's or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
I'm going to get
You said in
higher.
the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side. either because, we do see that, that companies still report that there are supply side issues that they're facing. And also, even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either strong, either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel.
Gina again, please.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%.
Hi, Rachel.
It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we've said is that we need to be more confident, and we've said, my colleagues and I today said, that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of conference. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Sunscreen in my eye.
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months' data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking.
Bullish.
And Mr. Chairman, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view, I think, that in fact we didn't gain confidence and that it's going to take longer to get that confidence. I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened. I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in-housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a plan we've long had in place to slow, really not in order to, to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig.
Craig Forrest from Bloomberg. Two questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it'd be appropriate to cut until we were more confident that inflation was moving sustainably at 2%. Our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's, the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It's the time to get back there times times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation. And this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it, and that's how we think about that.
Sure, Data Powell. Sure, Data Powell.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask
Great
the questions.
voice.
Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It'd be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure. And we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say, most forecasters, including our forecasting, was that that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
Toy.
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022.
He's having trouble saying words
today. I think
today.
it's hard to draw from the data. The question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year, for that matter, too. So I think in that case, I think you really do have a significant increase in potential output. But you've also got you've got more supply, but those people also come in, they work, they have jobs, they spend, so you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive, and our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years, and that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Edward.
Gina again, please.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current the current level of restriction. That's really that's part of the policy. That's where the policy discussion was in the meeting.
Yeah, I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Totality. Solar eclipse
Hi, Victoria
fight.
Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the
Could you be
bar for
political?
rate changes higher close to an election? And similarly, is there a significant economic difference between, starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December? An economic
There's a
difference?
significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is. And we just don't do that. I mean, you can go back and read the transcripts for this is my fourth presidential election.
Did he just say
Read all the
sexy
transcripts
under his breath?
and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
We
Thank you,
really
Chair
have
Powell.
that many
Question
viewers?
about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Gina, more questions, please. Nancy. All right. Nancy. Nancy.
Nancy from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well,
have fun being poor.
The thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck, and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at, anyway, headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes, I mean,
No,
I think
I don't
that
think so.
restrictive monetary policy is doing what it's supposed to do, but it's also in this case unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason why we're having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Where's the data, Chair Powell?
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent. And you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thanks.
Thank you, Chair Powell, for taking the questions. This
Chair
is
Powell.
Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably a significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened.
Hello.
And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that, but, it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. A couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
All of them.
Chair Powell, thanks for taking the question.
Chair Powell.
Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. Nothing. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Last question, Mark. Better be a good one, bud.
Thank you, Mark
A lot of
Hamrick
pressure.
with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing, if someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not, it's not, frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group around the people, frankly, more diverse
Terrible
than it used
last
to be
question.
in many dimensions, more diverse from the obvious, gender and demographic ways. But also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question though. Thank you very much.
Terrible last question. Terrible. What an amazing FOMC. It truly was the biggest ever. Our predictions at the beginning of the stream came true right in front of our eyes. The Fed tapering quantitative easing. We're going to be seeing liquidity injected into the market, dollars injected back into the market. This is bullish for risk assets. Bitcoin rallied off of the announcement along with gold and stocks, I believe. There it is. And stocks. The dollar took a beating, but is now bouncing, and we're seeing kind of everything play in reverse. Pretty typical price action. Wow. Pretty typical price, expectation for what was going on today. No interest rate cuts, but we got that beautiful tapering. That tapering. Good stuff. This has been a heck of a stream, guys. Make sure you've subscribed. We're here live making content every day. The best in the biz, the creators of the FOMC. Make sure you join the Discord, discord.gg/Tom Crown. Keep on top of all of our newest content. Sign up with a partner in the video description below and get your VIP access for free. Absolutely. Hell of a stream, guys. Thanks for joining. We'll be live again Friday at the latest, maybe even tomorrow if it's spicy. That's all for